Hello, traders. Gary Wagner here, just after 12 noon in Honolulu, 5 o'clock in New York on Monday, 14th day of November 2022, and this is the daily report for gold and silver. Gold had a nice recovery after trading to a low in Australia of $1,755.80 Monday morning there. Currently, we have gold up $5.90. That is a net gain of 0.33%, with December futures currently fixed at $1,775.30. That in spite of dollar strength today. The dollar is up by 0.55%. You can see that represented on this daily candlestick that is just above Friday's low at 106.745. Lastly, silver gained just shy of 2% today, a net gain of 41 cents, and December futures are currently fixed at $22.08. First, to our open order that we have to buy December gold at $1,643 as a limit order and place a stop at $1,737. It is a tight stop. We know that. But what we're hoping to see is after this tremendous rise in gold, which in essence formed a triple bottom at approximately $1,621, we would expect to see a decline or correction of approximately 23%. So by putting it at 1743 with the 23.6% retracement at $1,741, we believe we can effectively enter on a dip in the market or a short correction. Up until now, this rally can be best characterized by long periods of price ascent and very shallow and short periods of price declines or mild corrections, as you can see here. This is a Heikin-Ashi chart. We're going to use it to see how strong the trend currently is. When the trend is very strong, it's characterized on this chart type with a very, very long body with the absence of lower wicks. As the trend begins to diminish in terms of strength, you get a shortening of body size. And here's a scenario in which the market, in essence, formed a base or traded sideways. You can see that because, one, you have alternating candle color, two, small bodies with wicks on both sides. We then returned to rally mode, and you can see that we had strong and large body size until we had this small dip, and that's what we're looking at right now. We've seen body size diminish. There still is the absence of the lower wick, but this last candle that came in, and this, of course, is a 60-minute chart, you can see is actually pivoted to red. We are looking at a daily candlestick chart with the 50-day moving average as well as a Fibonacci retracement set. The Fibonacci retracement begins at this last high at 1824 down to this triple bottom at $1,621. What is interesting and I believe extremely noteworthy is that we have characterized the fall from March of this year as a series of lower highs and lower lows. We then saw a triple bottom form, which is indicative of very, very strong support. But more importantly, when we look at the most recent high, and as I said, we've had a series of lower highs, we actually got our first higher high than the previous high, which is absolutely significant. If we are fortunate enough to have the market dip and fill our limit order at 1743 in terms of our upside target, it is going to be a challenge of this recent top here at $1,825. The reason I believe so is that we got our first higher high after this long series of lower highs that came in from March through this double bottom. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.